The Basel Index, or Basel Accords, represents international banking regulations by the Basel Committee on Banking Supervision. Its primary aim is to strengthen the regulation, supervision, and risk management of the banking sector worldwide. The intention is to ensure banks have enough capital to absorb unexpected losses, promoting global financial stability. The origins of the Basel Accords trace back to the 1970s, spurred by international banking crises. Basel I, introduced in 1988, aimed to create a resilient global banking system. The Accords establish minimum capital requirements to prevent regulatory arbitrage and enhance transparency. However, implementing these global standards has challenges. The one-size-fits-all nature raises questions about serving diverse economies. Do these standards favor developed financial systems? The pursuit of stability shouldn't hinder poorer nations' development. The real test lies in how these rules impact economies and people on the ground. Basel I, introduced in 1988, focused on credit risk, requiring banks to hold capital equivalent to at least 8% of their risk-weighted assets. As the financial world grew more complex, Basel I's limitations led to Basel II in 2004, introducing a three-pillar approach. Pillar 1 expanded capital requirements to include operational risk. Pillar 2 emphasized supervisory review. Pillar 3 focused on market discipline through enhanced disclosure. The 2007 to 2008 financial crisis exposed weaknesses in Basel II, prompting Basel III. Basel III, published in 2010 to 2011, significantly strengthened global capital and liquidity rules. It increased the quality and quantity of regulatory capital and introduced new liquidity coverage ratios. These evolving standards reflect a continuous effort to learn from past crises. The core principle remains: banks must maintain sufficient capital reserves to act as a buffer against losses. However, the increasing complexity and stringency of these rules raise concerns about compliance costs and their impact on lending. The quest for stability must be balanced with other economic and social goals. The implementation of Basel Accords reveals significant disparities between developed and developing nations. Developed countries generally possess robust financial infrastructures and strong regulatory bodies. In contrast, developing countries face challenges with smaller, less diversified banking sectors and limited resources. The one-size-fits-all approach of the Basel Accords can be problematic for smaller, domestically focused banks in emerging markets. The cost of compliance can be disproportionately high, potentially stifling economic growth. Stricter capital requirements could make banks more risk-averse, reducing lending to crucial sectors like agriculture or SMEs. The international financial architecture often reflects the priorities of major economic powers, potentially reinforcing global economic imbalances. A more nuanced and flexible approach might be necessary to ensure global standards support inclusive growth. The United States has been proactive in adopting Basel requirements, especially post-2008 crisis. Large U.S. banks face stringent capital and liquidity rules, strengthening their resilience. However, increased regulatory burden and capital costs have sparked debates about their impact on lending. Nigeria, a major developing economy, has made strides in adopting Basel II and moving towards Basel III. Compliance has improved risk management but poses challenges, particularly for lending to SMEs. Lebanon's recent economic collapse highlights that mere technical compliance with Basel rules is insufficient if underlying economic fundamentals are unsound. These case studies illustrate the varied impact of Basel Accords. In developed nations, the focus is on trade-offs between stability and credit availability. In developing countries, the challenge is balancing international standards with national development priorities. In crisis-hit nations, regulatory frameworks alone cannot save a system from fundamental mismanagement. The real-world application of these global rules is far from uniform, and the consequences are deeply felt by economies and their people. The Basel Accords, while aimed at systemic stability, often carry a significant human cost, particularly in developing nations. Stringent capital requirements can make banks more risk-averse, impacting SMEs' access to credit. Reduced access to credit can stifle entrepreneurship, limit job creation, and slow poverty reduction. Depositors in developing countries can face adverse consequences, especially when financial systems are fragile. The critical question arises: do the Basel Accords genuinely promote global financial equality, or do they deepen the divide? Applying these standards rigidly to developing countries can create an uneven playing field. It may impose costs and constraints that hinder their ability to build financial systems suited to their specific developmental needs. There is a need for greater voice and representation for developing countries in formulating these standards. Advocating for fairer, more inclusive financial practices is essential. The goal should be a global financial system that is not only stable but also equitable and supportive of shared prosperity.